Good afternoon, everybody. It's Christian Jarvis, Senior Investment Advisor at Canaccord Genuity in Vancouver and head of the Jarvis Wealth Management Group. I hope that everybody's having a wonderful day. Today, we're going to cover a topic that's been pretty popular in 2022, especially if you've been watching the news at all, and that is inflation and rising interest rates. So what I'm going to do first is I'm going to run through some slides and charts that just really outline what inflation is exactly, how it's measured, and how it behaves over time. In the second part of the video, I'm going to cover a few areas that people might want to keep an eye on just to make sure that they're as efficient as possible in a rising rate environment. Also, just a quick note for our viewers watching this on an iPhone or a smartphone. Sometimes the screen is a little bit small, especially when it comes to looking at charts. If you tap on the video and then look for the white square in the lower right-hand corner of the video, and you tap on that and then tilt your phone sideways, you're going to end up with a much larger image and probably find it easier to view the charts that we're going to be walking through. So without further ado, I'm going to jump into some charts and we will walk through exactly what inflation is. Okay, so we're going to start with a fairly common and basic commodity, and that is a Canadian postage stamp. If we go back to 1969, the face value on a Canadian postage stamp was 6 cents. If you fast forward to 2022, that same stamp on the face value is $1.07. Now, at the post office, I had a conversation with the young man selling the stamps, and he argues that it's actually only 92 cents a stamp. Once you back out, I think it was a charge of some sort or a tax. But bottom line is face value. It was 6 cents for a stamp in 69, and in today's dollars, it's $1.07. So that's about an 18x increase over that period of time based on inflation, or due to inflation, I should say. Now, what we have next is a chart here looking at historical inflation in the US, but it's been very similar in Canada. So we can use this chart to get a gauge of where we've been. So let's start at present, actually, 2021, 2022. This chart showing inflation at about 6 or 7%. Now, this is net of energy. So if you add energy costs back in, it's going to take this chart closer up to 8% and 9% inflation, which is about what US inflation hit earlier this summer, just over 9%, a little bit lower in Canada, but nonetheless, inflation is much higher than that 2% to 3% rate that the central banks are trying to keep the lid on and keep inflation rates at. So this is why interest rates are rising now. We'll get to why in a little bit later, but rising interest rates right now to curb this high inflation that's running in about the 8 to 9% range. Now, if we jump back to the early 80s, that was the last big spike in inflation. It ran up to about 13%, and at that time, for those of you that remember, interest rates, prime anyways, spiked all the way to 22% to keep inflation in check. And the time before that, the period before that was in sort of the early to mid 70s during the oil embargo. That's when inflation ran up to about 12.5%, and interest rates followed closely behind, rising as well to try and curb inflation and keep that in check. Again, back to that 2 to 3% level that the central banks are trying to keep inflation at. Now, what is inflation exactly? Well, it is the upward movement of prices over time. In North America, it's measured by the CPI, or the Consumer Price Index. And just out of interest, these are the various components. The four big ones, main ones I've circled in red here. So we start with shelter, which is 33% of the index. And that is rent and rent equivalents. We then move over to food, almost 14% of the index. And if anyone's been grocery shopping or to restaurants as of late, they're going to know what I'm talking about with rising food prices. We then move over to transportation and energy. And those four components together really do make up the majority of what's in the basket of this goods and services basket called CPI. And right now, these prices are raising on average at about 8 to 9% in North America, which is quite high indeed, especially when compared to the 2 to 3% range in which the central banks are trying to keep things capped at. Now, the final slide we're going to look at here, we're actually going to jump to the Bank of Canada website. It may take me a second here to flip between screens. Bear with me 1 second. I just want to make sure that I'm sharing the correct screen. Okay, so here we go. This is directly from the Bank of Canada website, and this is a calculator that goes all the way back to 1914, starting with a basket of goods and services priced at $100. Now, that same basket coming all the way forward to 2022 would be $2,543. Call that $25.50, or a 25.5x increase in that cost of basket of goods over that period of time. Now, that's just over 100 years, and inflation in this case was running just over 3%. Now, that is quite a long period of time and going back quite a ways. Let's bring it up a little bit closer to the future. We'll start in 1969. The reason I'm going to use that period is because it coincides with the Canadian postage stamp example I used. Now, this same basket of goods costing $100, coming from 1969 to 2022, that's just about 50 years, having inflation running on average over that period just under 4%, that same basket of goods comes to $766, or about 7.5x increase over that period of time. So fairly dramatic as well. Again, what I was just trying to show with these last few slides and charts is what inflation is, how it's measured, and how it's behaved over time. So hopefully those slides illustrated just that. Now, in this next part of the video, I'm going to just go into a couple of areas that people might want to keep their eyes on just to make sure they keep things in check during this rising rate environment. Now, before we get there, a good place to start would be, why do central banks raise rates in the first place, and how does that help curb inflation? Well, the bottom line is inflation happens when we have too many dollars chasing too few goods. And based on all the money printing that's been happening over the last 5-10 years or so, coupled with the bottleneck in supplies coming around the world at the moment, and a spike in oil prices, we definitely have an environment here for inflation, particularly with too many dollars chasing too few goods. So what happens is when interest rates rise, it slows spending and encourages saving, to keep it as simple as possible. And what that does is it reduces those number of dollars chasing goods, and slowly but surely inflation is curbed and prices do start to drop down again. Now, the central banks in North America likely are going to raise rates a couple more times at least before the end of the year. So our hope is, as unpleasant as that can be, that these rising rates are going to slow down inflation and bring it back from the 8 to 9% range down towards that 2 to 3% long-term range the central banks are trying to cap inflation at. So as far as personal finances go, a few areas people want to definitely look at and keep in mind are as follows. And number one is definitely any outstanding debt. So if somebody has outstanding debt, whether that be a personal line of credit or credit cards, especially, particularly department store credit cards, you definitely want to look at reducing those outstanding balances and consolidating them to any sort of lower rate loan you can get, just to keep those interest rate costs in check and under control, because in a rising rate environment, that cost and that expense is definitely going to be moving higher. Now, this leads into the next area that I really think is important for people to take a look at, and that is reviewing their budget. So I think, or their financial plan, and I do think that people should review their financial plan at least once a year. When you look at the balance sheet component of your financial plan, there is going to be a debt section, and along with that is going to be the cost of debt. So again, that is an area that wants to be analyzed, and make sure that in all possible ways, any outstanding debt, unless it's, well, there is good debt. If you've used it for investing purposes, that is another story, but any sort of outstanding debt that has not been used for investment purposes, you want to make sure you're checking those expenses and looking for any sort of consolidation opportunities to bring those costs of borrowing down. Now, the next big area of consideration is the effect that rising interest rates are going to have on the housing market. So if you do happen to have a mortgage outstanding and you're looking to renew, or you're in a variable situation, you're going to want to review this very closely with a professional, either a mortgage broker or a financial planner, and make sure that if things are restructured or renewed, it's done in a way that is going to keep your cost of borrowing down as low as possible, especially if you're in a variable rate situation. Now, the other thing to keep in mind is if you are in a position to buy and you're on the sidelines right now, either looking to get a mortgage or you have cash in hand to buy, consensus is saying that housing prices in North America and in Canada, especially, is where we're focused here, they're definitely looking as though they're going to soften here over the next 3 months, 6 months and beyond. So if you are looking to buy, and you're not in a rush, you may look to take a bit more extra time here, as it looks as though it's going to be a buyer's market for time to come, and prices will continue to soften going forward. Now, the next area of consideration is any sort of low interest savings accounts. If you have money parked anywhere, maybe squirreled away in a checking account that hasn't been looked at anytime recently, many of those accounts are paying a whopping 1/4 to 0.5%. With rising interest rates, we have a number of instruments now that are paying much better rates than that. Here at Canaccord, we have high interest savings accounts with daily liquidity that are paying as much as 3%. Those will automatically continue to rise with rates if rates do continue to rise. We also have an incredible lineup of GICs. We have the largest cash management desk in Canada right here in Vancouver at Canaccord. And we have rates now going anywhere from 3%, 4%, 5%, and higher, depending on the term and the structure of the GIC. So that's something else that you might want to consider looking at if you have money tucked away in a low interest savings account elsewhere. Now, the final area I'm going to discuss is the labor market. So if we have a young person or a young viewer, maybe a grandchild or a child of some of our clients, maybe just coming out of university or looking for a job, or someone also looking for a career change, with struggling financial markets and rising inflation, it has definitely become a tight labor market. And the cards are in the hands of those looking for work. So I've talked to both employers and those for looking for work. And again, it is definitely stacked in the hands of those looking for work. So this is the time, if you are looking for employment or to make a career change with such a tight labor market, opportunities abound. So that is a bit of a silver lining to the cloud here as far as the current environment goes, and something for people to keep in mind. So again, that's pretty much it for today's video. I wanted to just run through things fairly briefly and quickly from a high level, talk about inflation, what it is, how it's measured, how it's behaved over time. And of course, with rising inflation does come rising interest rates. We're in that environment right now. So I did want to suggest a couple of areas people might want to keep their eye on, just to make sure they're being as efficient as possible in this current rising rate environment. So thank you so much. If you have any questions, please feel free to reach out at any time. All my contact information is below in the description. Until next time, in our next topic, I look forward to being in touch. Wishing everyone a wonderful day. All the best to you, and please take care.